You don't go to Notre Dame University to learn something. You go to Notre Dame to be somebody. So said the coach of the Fighting Irish, Lou Holtz. Hello and a warm welcome to all the viewers of Wizards of the Street. I'm your host, Ramesh Tamani. So how did Notre Dame, his alma mater, and his years at Fidelity shape him? And today, where does he spot opportunity? My guest manages over a $7 billion corpus at Fidelity International Discovery Fund. He also co-manages the Fidelity Sustainable Equity Fund. Let's hear directly from him. Please help me welcome from Fidelity Investments, Portfolio Manager, Bill Kennedy. Bill, welcome to Wizards.
Hi, thank you very much, Ramesh. Very nice to see you.
Bill, it's a great honor to have you.
Yeah.
Let me start with the earlier years. You had a degree in economics.
Yep.
Given the course that your career took in the world of investments,
absolutely.
If you had a do-over, what major would you pick?
Oh, boy, that's a tough one. I wouldn't change anything. I mean, I've had such a great run investing. The world of investing has, treated me very, very well. I was an economics major, as you mentioned before. I studied economics, and the one thing you learn when you study economics that it's hard to predict the direction of the economy. It's hard to predict, the direction of interest rates, and given what's happening all around the world, it's hard to predict the direction of inflation. The one thing I did learn at Notre Dame and in a lot of other places was, the fact that businesses that are run well by good entrepreneurs that have their shareholders in mind and have society in mind tend to do well over a long period of time. What would I change? I would probably change nothing. The good thing I loved about the program I was in, it was really flexible. I could study economics, and I learned in economics that it is very difficult to predict the outcomes of the economy. So I decided to take on a lot of business classes. So I took finance, accounting, marketing, management, investments, but also that it was flexible enough where I could take, philosophy class, theology class, a class on Asian history, and that allowed me to kind of fine-tune a different part of investment. Business classes will teach you what's good, how to read a balance sheet, how to understand a P&L, and how to understand how businesses function day to day. And that's the science of investing. But to me, what really helps me ultimately, and I think you'd agree with me and a lot of the people that have sat in this chair would, it's the art of investing that's really important. Reading the management teams, reading the market, reading, there's a lot of nuance in investing.
Psychology too.
Psychology, exactly. And I'll tell you, one of my kids is a psychology major, and reading human behavior is really important in the world of investing. And that helped me a lot and helped me kind of fine-tune that art of investing that I think is really important. And I think people underestimate how valuable that is.
Yeah, Buffett taught us that the market swims between fear and greed, and if you can conquer that emotion, you're probably ahead of this game.
Exactly.
Anyway, but you talked about taking a class in Asian history.
Yeah.
So my question is, how does a student in Indiana, Notre Dame, get interested in India and emerging markets?
Well, it was fascinating because back then, think of the late 80s. Japan was just clobbering everybody. They were producing better cars. They were producing better consumer electronics. They were producing things cheaper and better than pretty much anywhere in the world. Everybody in the United States was worrying about losing market share. They were worried about losing, competitiveness to Japan. I just read a book about semiconductors. The semiconductor industry was going through a big change in the United States because companies like Sony were just producing much better goods than their peers in the United States. And so I took a class in Asian history just to figure out, how did this happen? And the thing that really piqued my interest was Japan was doing very, very well, but there were other countries, Hong Kong, Taiwan, South Korea, Thailand, Indonesia, Malaysia, that were starting to really...
The smaller tigers.
Yeah, the smaller Asian tigers that were really kind of bubbling to the surface. And I said, that's where the next opportunity is going to be.
You figured that out sitting in Notre Dame class?
Yes, I did, because you could see the economic growth, and you could see that they were making a lot of the reforms, and they were learning from the Japanese to see some of the mistakes that were made in Japan. But they had that base of the Chinese family companies that were really incredibly entrepreneurial and could grow their businesses and were, incredible, capitalists by their inherent nature. And they, so you could see that these countries were about to just burst at the seams in terms of economic growth. So that really excited me. So I wound up taking a job in private equity in America with the Prudential. And I was there for a year, and just by happenstance, an opportunity came up to work for them in Asia. And that was a dream come true. So I picked up, I was 22 years old, picked up my bags and moved to Hong Kong.
Are you seeing India now becoming the China +1+2 strategy?
Well, I think China has gotten more expensive. And if you ask companies in general, they're more biased to moving to Vietnam or to Mexico. However, you're starting to see companies, as you know, like Foxconn is producing, producing Apple products here in India. And my understanding is the goal is to, by 2025, to have a material amount of the iPhones manufactured here. So India is benefiting from that, definitely. But my sense is that, that will be a process that will certainly develop over the next couple of years. The only thing that's really needs to happen in India is just favorable government policy to make that, accelerate that process.
Which they are doing perhaps through PLI and through budget reform. But you're a student of history and you're a student of economics. Does that suggest to you at some point Asia becomes uncompetitive and you move to, say, Africa?
Well, the one thing in Asia that has really impressed me is the ability to have productivity gains. What ultimately grows an economy? Population growth, which most of Asia, bar China, has, and then productivity gains. And if you look at the productivity gains that have been accomplished, particularly here in India, in Vietnam, Taiwan, Korea, I mean, it's been pretty impressive. And a lot of countries in Asia continue to go up the value-added curve, and they have high savings pools and very high education rates, and that's what makes, that's a beautiful combination for productivity.
When you met over dinner, you made an interesting point that you felt that Indian companies deserved a better multiple than Chinese companies. Why is that?
Well, when you think about it, what goes into a PE multiple? I look at it and say, it's the growth rate that they can do over the midterm, it's the cost of equity, the cost of equity that they're facing, and their ROE. Okay, I would argue that given the structural growth in India, the demographic dynamics here,
which are so much more positive.
So much more positive than China. I mean, China's population has peaked. India's population continues to grow. So the growth rates structurally are better here in India. You have cost of equity is higher here in India. Clearly, interest rates are higher in India. I would argue that that will come down over time, but they're still higher. But the ROEs in India, if you take an Indian company versus a Chinese company, and that's what impressed me when I first came to India, is how high the ROEs are relative to their emerging market and their developed market peers. And I do believe it's really a function of the fact that management teams, because they're mostly owned by promoters, tend to sweat the assets because they're turning the lights off at the end of the day.
Because capital is important.
Exactly, and capital has a cost because they don't want to be diluted. And interest rates are higher here, so the cost of capital is higher. Therefore, assets are very valuable, and they're going to sweat them and to try to improve the returns they can earn on them.
Interest rates are zero, everything looks interesting.
Exactly.
That's not true at a high interest rate.
Exactly, and that's exactly what happened in Japan, and unfortunately it's happening in China as we speak.
It's a curse. The low interest rate became a curse. You came to India the first time.
Yeah.
You've been coming frequently, I know that.
Yeah.
But the first time in which year?
1994.
1994,
Yeah.
just after the big bubble of 92 had burst and foreign investors were allowed into India.
Exactly, yeah.
Right. And which is the first company that you met?
Well, on the first day, the first company I met in India, first day, was HDFC.
That's remarkable, isn't it? It's like meeting Warren Buffett on your first day in Omaha.
It really is. And, it's just, because I had, 2 nights ago, I had dinner with Keki Mistry, and, we were talking about it. And, it's just amazing when you can look at a company and, by public disclosures, it's still in my top holdings, and a company that has been able to withstand the test of time. The management team at the time laid out a path for how they could grow 15 to 20% over a 20-year period of time. Now, if a company were to tell you that today...
In the 90s.
Yeah, in the 90s. If a company were to tell you that today, you'd be pretty skeptical, wouldn't you?
Of course.
But just given, the demographic dynamics and given all of that, given, the low penetration of mortgages, given the quality of the management team, the competitive environment, in 94, the case was, that could happen. The execution is clearly what, myself as an analyst at the time, as a young analyst, would have to monitor. And, clearly in looking in, what they've done over that period of time, they've, clearly executed.
But you believed that in 94 that they would grow at 20%?
Yeah, of course.
It was that obvious to you?
Yeah, and, it's, a holding in, as of the latest disclosed holdings in the funds, it's, clearly
It's still
been
in your
there.
top 10, I think.
Yeah.
Bill, you come from a culture, Fidelity, which
Yeah.
is known for stock picking,
Yeah.
great
Oh,
star
yeah.
managers
Yeah.
out there. Talk to me a little about that. Gerald Tsai, Peter Lynch, all those are
Yeah.
great names in Wall Street.
Yep.
What did you learn from them, and how does that influence you today?
I'll tell you, the great thing about Fidelity is not only the individual personalities. Jerry Tsai was an aggressive growth investor. Peter Lynch was,
The Magellan Fund.
Magellan Fund, very famous investor. Right now we have an aggressive growth investor who's, has phenomenal numbers. Will Danoff, Joel Tillinghouse, phenomenal numbers, deep value. The great thing about Fidelity is you get great mentors, but also you get people that, the spectrum is so wide. So you can find somebody, you can always find somebody that agrees with you, but what I like about Fidelity is you can find people that disagree with you.
Without being disagreeable.
Without being disagreeable. So what I try to do is I try to go out and hunt out the people that are on the margin, more value-oriented, because I tend to be growth-oriented. I'm investing in India, so
Right.
I have a big overweight in emerging markets. So I go out and I try to find people that are a little bit more, interested in buying deep, discounted, companies that are inherently, trading at single-digit PEs or, the market just really doesn't like. And I try to say, hey, listen, I've got this company in India. It's expensive, but, this is my investment case. What do you think? And I want them to pick it apart to keep me honest.
Have you ever introduced Peter Lynch to any stocks in India?
Yeah. Keki Mistry did come in and talk to our senior management team at one point in time, and Peter. I don't want to speak for Peter and his views on the company, but clearly the parallels between HDFC and Fannie Mae, certainly rung a bell. And Peter Lynch was always a big fan of, in all of his books, of Fannie Mae.
Well, the parallel between American television and Indian television is that we both need commercial breaks. We'll take a break, come back and chat some more with Bill Kennedy of Fidelity. Life, it is said, is the art of drawing without an eraser. Squiggles, stocks, serendipity, and more with Fidelity's Bill Kennedy. Bill, welcome back to the show.
Thank you.
A book that's widely famous in India is Peter Lynch's One Up on Wall Street. And he said, never invest in a stock that you can't explain to a kid with a crayon.
Exactly.
What is your investment philosophy? How would you explain your investment philosophy to your 4 children?
It's very simple like that. I look for companies with big addressable markets in front of them, where I can understand a market, how it's going to develop over the next 3, 5, and hopefully 7, 10 years.
And just to interrupt, do you take that cue from how, say, the mortgage market developed in America or how the automobile market developed in Japan?
Yeah,
so you have a reference point.
You have reference points, but you have to adopt it because each country is different and each point in time is different. So you can't necessarily say, well, it happened in America in the 80s, so it's going to happen in India today. Because
that's too simplistic.
That's too simplistic. But you can try to draw parallels, and you can try to analyze it with a given visiting companies and all of that to try to put it in a cultural and a current context. But I look for big total addressable markets, and then the second thing I look for is a good management team that can take advantage of that. Clearly, I travel a lot. About half of my time is spent on the road. This was pre-COVID, and now we're back, out of COVID, and I'm just been on the road now. I've been on the road most of the year, and I still have travel plans through basically the middle of March. Visiting management teams are really important to me, and understanding is this the right team on the field to take advantage of that total addressable market?
Everyone says management, but how does Bill Kennedy gauge management?
You spend a lot of time with them. And you get to know them over a long period of time. If you look at my top 10 holdings, I have had those top 10 holdings for a long period of time, and I've known the management teams for, chances are I've known the management teams for over 20 years.
So you look at what they promise versus what they've delivered. Is that your test?
To promise and what they deliver, and very critical in terms of how they allocate capital. There's a book called The Outsiders by Thorndike, who wrote a book, and he says the best way to measure CEOs is based on their capital allocation decisions. They have COOs running the operations. They have CFOs to keep track of how the books are coming together. They have chief marketing officers to sell the products. The CEOs are responsible for the capital allocation decisions, and the capital allocation decision That's where the buck stops as far as the CEO is concerned. So I look a lot at that and measure them according to that.
And you measure them by the return they're generating.
Return on capital employed.
Return on capital
Yeah.
employed. That's
exactly. And lack of dilutive acquisitions.
Right,
Yeah.
which is, of course, the bane sometimes of
Yeah.
on the top of a bull market.
Exactly.
You know, so there are a lot of ratios that people use.
Yeah.
You know, P ratio, return on equity,
Yeah.
market cap,
Yep,
cash
yep,
flow.
yeah.
What would be your most important? Is it return on capital only?
It's return on capital, free cash flow yield. So investment process, look at total addressable market management. Next thing is valuations. I do a lot of work on valuations, and my kind of go-to metric at the first glance is free cash flow yield. Because what does that do? It's a nice, neat ratio because it allows you to show efficiency, how much cash are they generating. They may be generating net income, but can they convert that into cash? And it's a nice valuation measure because it takes the enterprise value of the company and also the yield, if you will, that you're getting on that enterprise value. So it's nice and neat and kind of boxed up. I will look at PEs. I will look at other more traditional valuation measures, and I'll see how they are trading over time. But the flaw in that analysis is that this company may be a bit different right now, and therefore it may not warrant looking at it relative to where it has traded in the past.
Right, and that's the one figure that gives you
Yeah.
the true measure of management's efficiency.
Yeah. And the other thing is when I look for companies with good balance sheets, and that incorporates, because you're looking at it over the enterprise value, it incorporates the balance sheet as well. So it packages it nicely, the free cash flow yield.
Correct. A man who doesn't love London doesn't love life. Yeah, thank you, Samuel Johnson. Is that still a good place to watch emerging markets?
It's great. Yeah, it's because you're right in the middle of it. I have recently moved back to the United States, but I was in London for 15 years. I still keep a home there. And as I travel, during this period of time, I use it as my base. But it's a great place. When I wake up in the morning, Asia's open. Europe opens very quickly, and then I can, at night, continue to watch the U.S. and LatAm close. It's great. It is. It's really great, and it's a wonderful city to live.
Bill, as a part of the show, we always do a rapid fire. Are you open to a rapid fire round?
Yeah. Okay. But of course. Yeah.
Go ahead. Say what you're saying.
Yeah. But some of the one thing that I've learned, and piece of my investment advice that I've always been given is don't predict the direction of markets. That's always a hard one.
Understood. But we've already made the disclosure that you're a marathon runner, not a sprinter. You have needs to prove it.
All right.
So let's just try that, okay? An Indian promoter that you have admired over the 30 years you're visiting India.
Well, I mean, we use the HDFC example, so I'll be consistent in my thoughts. Deepak Parekh, has been, kind of the guiding light behind the strategy there. So, clearly, just, very admirable individual.
Great. You live in London, you travel the world.
Yep.
3 people you could invite to your house for a drink and dinner. Who would they be, living or dead?
It's a very eclectic group of people. First one would be Ben Franklin.
Really?
Yes.
He's a lovely
human being.
Munger's favorite too, Charlie Munger's.
Oh, yeah. Oh, I did not know that. And I didn't choose him because of that, because I honestly didn't know it. He was a scientist, a tinkerer, an experimenter. He was
statesman, philanthropist.
Yeah, philanthropist, a diplomat. He did a lot of things in a lot of different areas. He had the science part of his brain, the artistic part of his brain, all wrapped up together. He would have made a perfect investor.
Ben Franklin. The other 2?
George Orwell. I mean, you look at his writings, 1984. Look at what's happening in technology. How right was he?
Animal Farm.
Animal Farm. All animals are equal, but other animals are more equal. I mean, how right is that in politics and a lot of things in society today?
Last one.
No, so that to me shows foresight, which is important in investing.
Investing, of course.
And the other one is Harriet Tubman. Harriet Tubman, I've spent a lot of time studying the Civil War in the United States. She ran the Underground Railroad in the United States, helping slaves escape from the South into the North. She was bold, she was dedicated to her cause, she was tough as nails, and she led from the front, which was really important in my mind.
That is an eclectic list. A politician in an emerging market who gets it.
I'll tell you, we're not politicians at Fidelity, so I'm looking for the next Lee Kuan Yew. I really am.
From Singapore.
Yeah, Lee Kuan Yew is, obviously.
They don't make him like him anymore.
They don't make him like him. He was bold, and he took a country, that had a messy divorce from Malaysia, and now look at it.
A generation changed it.
Exactly.
A great choice. The best investment advice that you've ever received?
Don't fall yourself to thesis creep. Whenever one point in your investment thesis tends to creak a little bit, The others start to fall pretty quickly. I have found that good sellers of stocks, when the thesis changes, tend to be very good investors.
And by that you mean if your investment thesis changes, sell the stock, get out of it?
Yes, the problem we have is when we visit management teams, we tend to really like the management teams. We tend to, in general, have very positive biases towards them, positive feelings towards them, but stories do change. And when they change, you have to be very dogmatic in terms of selling.
The world is getting richer, the world is getting more connected. So over the next 5 years, would you buy luxury goods stocks or semiconductor stocks?
Well, if you look at the midterm, semiconductor stocks had a terrible year last year, and there's lots and lots of demand drivers. Demand drivers from AI, demand drivers from
data centers.
Exactly, data centers, a variety of applications. Where I would argue the stocks have gone down because of cyclical concerns, but the structural drivers have gotten better. That's usually a good risk reward.
So semiconductors. Yeah. My wife will be disappointed.
Yeah.
If I tell you ChatGPT, what do you say?
That's another driver for semiconductors. It's going to revolutionize AI, and you're going to need a lot of semis to do it. I tried to go on. I was telling you last night. I tried to go on and just enter in a few things, and they said, "Sorry, we're at capacity. Come back later." And that means that they need more capacity. That means more servers, more semis to power that.
Which would be a bigger hotspot in the world, Ukraine or the Taiwanese Straits?
That's a political thing. It's too hard to take a view on that.
Above your pay scale.
What's that?
Is it above
my
your pay scale?
Yes.
Okay.
Yeah.
Would you rather get seats to the Super Bowl game that's this weekend or World Cup football?
Well, I'm a diehard New York Giants fan, and
so baseball.
but the idea being that I root for the team. I root for the New York Giants and the team that's playing the Philadelphia Eagles. So I'd like to go and see the Chiefs beat the Eagles.
Okay. You travel for a living.
Yeah.
I mean, you're out of a suitcase most of the year. Which country would you like to visit as a tourist?
Whenever I get a chance to go on a holiday, I like to come back to India because I've seen India in a lot of professional settings. You stay in a hotel and you visit companies, you go to offices and all of that. And I try to travel in much of India at my leisure. So right before COVID, we went to northern Italy. I took my daughter to northeast to look at the tree root bridges.
Really? Yes, of course.
Which was phenomenal. She's a structural engineer, so she did her senior thesis on that. And that was amazing. And then I've been down to, a couple of years before that, we were down in Kerala, down in the backwater. So my next trip, I want to go up somewhere into Rajasthan and go hiking in the foot.
Well, your answer made you a lot of friends in India. I'm sure about that.
Yeah.
Thank you for that. The Tourism Authority thanks you.
Yes.
Higher or lower of the next year? Just
okay.
In your gut feeling. The Sensex.
Higher.
NASDAQ.
Higher.
Hang Seng.
Higher.
Gold.
Higher.
Bitcoin.
I'm not going to comment on Bitcoin. I'll comment on crypto. Crypto is very volatile and too difficult to predict. Above my above my pay grade.
Okay.
Yeah.
Oil.
Oil will be higher.
And the dollar.
The dollar will be lower.
Well, you've done a really good rapid fire round. Nothing makes a man so adventurous as an empty pocket. Victor Hugo. Actually, Bill, your adventures and investment acumen have filled a lot of investors' pockets. Thank you for stopping by on Wizards and being a part of our show today.
Thank you, sir. Appreciate it.
It's been a great pleasure.
Thank you.